Marcus, a study from McKinsey in 2025, revealed that companies led by CEOs in the top quartile for capital allocation decisions generated shareholder returns 3.5 times higher than their peers over a 5-year period. The difference wasn't innovation, market timing, or luck. It was discipline around where money went and where it didn't. So far, most leaders operate under a dangerous illusion. They believe their job is to grow the business, expand revenue, hit quarterly targets, hire faster, build bigger. But this thinking leaves billions on the table and destroys long-term value. The average CEO allocates capital reactively, chasing trends, funding pet projects, and splitting resources across too many initiatives. They're busy, not effective, and their boards notice. According to research from Deloitte's 2026 Global Capital Allocation Study, 62% of mid-market executives admit they lack a formal framework for deciding where capital should flow. That lack of rigor costs organizations an average of 18% in potential returns annually. For a billion-dollar company, that's $180 million left behind every single year. The pain isn't theoretical. It shows up in market share loss, missed strategic pivots, and talent exodus. When capital is wasted, the best people leave first because they sense the organization can't execute. Marcus, what separates exceptional CEOs from average ones isn't IQ or instinct. It's capital discipline. A framework. A way of thinking about every dollar as a strategic choice, not a budget line. Over the next 8 minutes, we're going to walk through 3 principles that the world's best capital allocators use to multiply returns. We'll show you real examples from Asia-Pacific companies that have cracked this code. And we'll give you a practical playbook you can apply to your own organization starting this week. This isn't about cutting costs. It's about directing force where it compounds. Marcus Principle 1. Rank returns, not projects. The evidence is clear. According to Gartner's 2025 Capital Efficiency Report, organizations that evaluate all capital requests using a single return on investment metric, not multiple conflicting criteria, show 41% faster capital deployment and 27% higher realized returns. Here's the problem most leaders face. Marketing wants budget for brand campaigns. Operations wants investment in automation. R&D wants to build the next moonshot product. HR wants to upgrade talent systems. Every request sounds urgent. Every request has merit. So capital gets split. 5% here, 4% there. Nothing gets enough resources to move the needle. The best CEOs rank every capital opportunity using one discipline: expected return versus cost of capital. What's the return on this investment at 3 years? Can we measure it? How certain are we? If it can't clear your company's hurdle rate, it doesn't fund. Period. Look at Singapore-based C Limited, the regional fintech and e-commerce giant. In 2025, they made a deliberate choice to concentrate capital in Shopee and C-Money, cutting discretionary spending across other divisions. They ranked their portfolio by return potential and diverted resources from lower quartile initiatives into first quartile opportunities. That focused allocation generated a 34% increase in cash flow visibility within their financial services division. Your application this quarter: inventory every capital request pending approval. Assign expected return to each one using your company's weighted average cost of capital as the floor. Rank them. Fund the top tier until capital runs out. This forces real priority. It kills the comfort zone where everything gets something. Sophia Principle 2. Time horizon governance. Here's where most executives get trapped. They treat all capital as fungible, interchangeable. $1 spent on core operations looks the same as $1 spent on exploration, growth, or transformation? Wrong. According to McKinsey's 2026 study on portfolio management, organizations that segregate capital into 3 distinct time horizons, core business, adjacent growth, and transformational innovation, generate 2.1 times higher total shareholder return than those that don't. The 3 buckets work like this. Horizon 1 is your core business. Maximize cash generation. This is 70 to 80% of capital. It should be disciplined, measured, and ruthless about efficiency. Horizon 2 is adjacent growth. New markets, new customer segments, extensions of existing capabilities. This is 15 to 20% of capital, and it has a different risk profile and time horizon than core. Horizon 3 is transformation. New business models. Bets on emerging technologies. Blue ocean moves. This is 5 to 10%. And you should expect to lose some of it while you're learning. The trap. Most leaders blur these buckets. They expect Horizon 3 returns from Horizon 1 investments. They suffocate Horizon 2 with core business discipline. And they underfund Horizon 3 because it doesn't show quarterly returns. Infosys in India offers a masterclass here. Since 2024, they've separated capital into 3 distinct buckets. Core IT services get funded for margin expansion and operational leverage. Adjacent services, AI-enabled consulting, automation advisory, get funded for top-line growth with moderate returns. And their internal innovation lab, which explores blockchain, quantum computing, and next-generation delivery models, gets funded for learning, not quarterly profit. This segregation allowed them to maintain 16% growth in core while simultaneously building credible positions in emerging categories, because capital expectations were aligned to time horizon. Each bucket could breathe. Your application. Map your current capital allocation against 3 time horizons. What percentage goes to each? Does your governance structure expect different things from each bucket? Reset expectations. Make them explicit. Your core business should maximize return per dollar. Your growth initiatives should maximize learning per dollar. Your transformation bucket should maximize option value. Once you separate them, you stop killing good ideas in the wrong bucket. Marcus Principle 3. Capital discipline through unforgiving pruning. The third principle separates good allocators from great ones. It's the one most leaders avoid. According to research from the World Economic Forum's 2026 report on portfolio rationalization, companies that retire or divest underperforming assets in the top quartile reallocate that capital within 90 days to higher return opportunities. The result: 5-year ROIC improves by an average of 340 basis points. Here's what most leaders do instead. They hold on to legacy businesses because they're profitable enough. They maintain programs because momentum exists. They fund projects because stopping them feels like failure. This is capital inertia. And it's invisible unless you measure it explicitly. The best CEOs ask a violent question every year. If we didn't own this business today, would we acquire it at today's valuation? If the answer is no, you have a choice. Fix it, sell it, or shut it down. But you don't close look at Alibaba's capital moves in 2025. Under new leadership discipline, they identified underperforming segments and either divested them or reallocated resources. Taobao and Xianyu, the core consumer commerce businesses, received concentrated capital for margin expansion. High return initiatives around Alipay received growth capital. Lower return legacy businesses were either sold or restructured. The pruning freed up $2 billion that would have otherwise been spread thin. That capital then went into fintech and cloud infrastructure, which generated returns in the 22 to 28% range. Without pruning, that capital remains trapped, depressed in legacy returns. Your application. Conduct a ruthless business unit audit. For each division, ask, would we fund this at today's valuation? If not, what's the path? Divestiture, restructuring, shutdown, or significant strategic pivot? Make the decision. Don't wait for the business to fail organically, and redeploy the freed capital within 90 days. That speed matters because it prevents capital from drifting into inertia. So fire when you master capital discipline. Something shifts. You stop being busy and start being focused. You stop reacting to requests and start directing resources with intention. Your organization feels the difference immediately. Team morale lifts because they see capital going into things that matter. Strategic clarity improves because resources aren't scattered. And your returns accelerate because money compounds in winning positions rather than getting diluted across too many bets. CEOs who crack this code don't just outperform their peers. They reshape their industries. They build organizations that generate sustainable advantage not through luck or innovation alone, but through systematic rigor in every dollar deployed. That's not spreadsheet work. That's leadership at scale. Marcus, if you want to become a CEO known for capital discipline, you need to build a data system that makes allocation visible and measurable. In our next video, we're showing you how to construct a capital allocation dashboard that gives you real-time visibility into. Thanks for listening. If you found this valuable, please subscribe to Apex Minds D4J for more powerful insights. See you in the next one.